welcome into this episode of Freightonomics on Thursday, or maybe later if you're tuning in. I don't think we're going to, well, who knows in this economy? A lot of news gets outdated quickly in this cycle, but Zach Strickland, head of freight market intelligence for FreightWaves Sonar. Thomas Wasson does a lot of things, especially with the enterprise fleet community out there, fresh off of the plane from a trip out east.
Technically east, the Carolinas, the folks at Volvo. So.
Yeah, the Carolinas about to maybe have a little tropical weather too. We'll get to a little bit later in the show, but we are nearing the end of the third quarter, Thomas Wasson. So today's show, a little bit of financial market twist to it. We just had the Fed cut rates, and that's been a big topic of, is it going to stimulate the economy? Will it not? Will the freight market feel some of the benefits or impacts of this downstream? All debatable things that we'll dive into, but he also Chair Powell also kind of threw out, a little reference to Alan Greenspan and the financial markets having an irrational exuberance tied to them. So we all feel the economy in different ways, and the financial sector, specifically the stock market that we watch on CNBC sometimes, hasn't cared. Like if you're in freight and transportation, I mean, the stocks individually have cared for the transportation sector, but the overall market, normally, like you've talked about transportation load volumes and this goods flow in the economy being very tied and connected to the financial sector. And that doesn't appear to be true, seeing as the last 3 years, Thomas, I think you will back me up potentially, because you talk to more of the asset-based fleets than I do nowadays. Have not been great for the transportation service provider community.
No, not at all. I mean, one of the big conversations that we keep hearing about was we had excitement at the end of 2024. We were expecting to see that we would finally see the upswing after the at the time, 2+ year long freight recession. We're now approaching our third, coming up on maybe fourth year of the great freight recession. The big thing is the T word. Tariffs and uncertainty have been happening with the new administration coming in. Feels like it's been 2 years. It's really only been 9, coming up on 10 months now, but that has really thrown a wrench in terms of what the overall broader, at least freight market, manufacturing economy. That recovery has been stalled because you just can't make a decision. I've got a lot of fun information from my trip with the folks in Volvo. We were in North Carolina and South Carolina. I got to go on the Michelin test track, check it out, check out some of their assets. But I had some great conversations as well, not only how this is impacting trucking, everything from purchasing decisions, commodity prices, fleet buying patterns, if they don't have any money, what types of trucks are they buying in this kind of recessionary environment, and especially what the next 3 months will mean as we're trying to set the table. So this is going to be a really important one. Q3 earnings are coming up. We're going to get some forward-looking statements that I'm excited to see, because right now it does not seem that we're going to have a good Q3 if you listen to not only some of our data sets, but from others. It's something that the great pump fake. Right now, it really likens me. You remember you see Charlie Brown? He's trying to kick the football.
Lucy.
Yeah, so Charlie Brown, in my instance here, for my parable, the parable of the freight market, Charlie Brown was the U.S. trucking industry. We were very excited. We are going to kick the football, which was hopefully enough profits to not go bankrupt. Unfortunately, Lucy in this story is the administrative-related changes and macroeconomic situation for people who do things. I'm not talking about AI or your crypto, but for things that are being made. And unfortunately, they took the football, the profits were gone, and now our metaphorical Charlie Brown, the trucking and supply chain, is on his back, staring at the sky, thinking, dang it, you got me again.
Yeah, and I think, we're going to sort through some data here today that helps explain this in a rational manner, not the irrational manner as I alluded to with the stock market situation, which of course has got other things going on into it. We're not going to break that down. That's CNBC's job. But from a transportation and logistics supply chain perspective, I think, something that you probably encountered at Volvo, like that's an OEM. They're a shipper. They're a manufacturer. Their perspective isn't just relevant to the transportation sector, but to all of the manufacturing and OEM community, as well as, anybody that is indirectly connected to it. I mean, if Volvo's doing well, that's a decent sign that a lot of other sectors are doing well as well. So if I can say well one more time. Why don't we kick things off, Thomas, with a little market in two and set the table with some data?
Let's do it.
All right, guys. When we're ready, Go ahead and let me know, and I'll start talking about it because I can't do this without visuals. There we go. All right, count me in, Thomas.
All right, let's do it in 3, 2, 1.
All right, kick things off with that demand. We were talking about the goods side of the economy a lot of times when we talk about freight, and that's why I start things off today with the outbound tender volume index. We have had a recovery in September of freight volumes, tender volumes, up roughly 2 to 3% over the average baseline in August. I think this is a fairly positive sign. Although, if you look at our comparisons year over year over year, not great still. We're still about 15% down from last year. You could argue last year was a little overheated. Those comps were a little tougher to make because of the pull forwards and stuff going on there. Long haul freight demand had not been purely eroded to the intermodal sector as it has this year. So it's still not a great demand side economy. Let's go to the next one. Even though there is a little bit of recovery in that. Let's go to the OTRI. The OTRI, this is your optimistic index. If you are a logistics service provider, transportation service provider, we're still holding on here. You saw the volume's been elevated and compared to August and September, but rejection rates also staying on this volatile track, staying elevated in September. And we have a more recent kind of tail here where this spiking rejection rate pushes us back higher. Still not enough to meaningfully inflate rates. Spot rates, as you'll see in the next chart here. Let's look at spot rates. They are elevated. They are staying up and a little stickier after the Labor Day holiday. Again, some mixing could be a factor here, but I looked at the back end data. It's really not. Length of haul staying fairly stable. Volumes are actually staying fairly stable on the spot market. So still a little bit of optimism here as we head into this fourth quarter. Thomas alluded to the football getting pulled out from the freight market. You can see that reflected in the 2024 green seafoam green line there, where that was the indication that this market was on the verge. Let's go to the last one here. Talk about maritime, because we're going to spend some time talking about the import side and, of course, tariffs. Flat right now. I think, and we can leave that last chart up for just a minute here, because this is going to segue us into, I look at imports two different ways, really. One is for a leading indicator. What's about to come into this, the environment. A lot of the operators, of course, most of this goes on trucks. At some point in time, it goes on a truck, whether it's drayage, getting off the rail, on the rail, even when we do have this like intermodal conversion thing manifesting right now. A lot of this freight ends up in the freight market on a truck at some point in time. So this is kind of a leading indicator. You see the big spike peak there that we had earlier than expected because of the trade war and this knee jerking around. What's fascinating, though, I want everyone to focus on this last little month that we've had. This is a very stable, and don't get lost in the year over year comps, because a lot of that was trade war stuff, pull forward and inventory type stuff, a little overheated economically. 2023 was the great inventory bleed off that ended. So people started kind of ordering again. So we had a little spike there right in front of peak season in August. Not happening this year because peak season happened in June and July.
Christmas in July.
Yeah. But the fact that we see stability at this point in time on the inventory and the ordering, I think I'm going to take this as a slight positive sign. Thomas, what do you think here?
More positive. I mean,
Yeah.
when we're trying to answer these questions, and you're a shipper and a supplier, what you want to do is try to settle into something. So this kind of represents to me that you figured out what you absolutely need. You finally come up with a plan to deal with most of the uncertainty. And so now the goal is to just be very conservative, it's a very bearish indicator for me at the moment, because we have all this pent up potential. But at the same time, you're seeing these volumes. It doesn't bode very well into Q4. We're going to really have to see if upstream versus downstream. Dr. Z is always great to talk to about that, because it does feel like, in my opinion, if I'm putting on my trucker hat, what I really need to see is, will we see that glut coming from upstream to downstream? And will there be something to eat enough downstream inventories to actually see that? Because the contracted rates, the outbound tender rejection rates, that's a good healthy amount. So like the craziest conversation right now is that volumes are at 2019 levels. If you pull up OTVI with seasonality view, we're down to 19. Probably 18. I got to go all the way down. We've got 2 years of data right here. But one thing I want to show on the volume index is we're basically on par with pre-pandemic levels, which in a normal society, that's not the end of the world, but we have too much trucking capacity. So we're still seeing this bifurcation where the spot market rates are still flat. We are elevated on year-over-year comps, which is a great sign, but that's not a good enough sign if you're a fleet in trouble. We're continuing to see pressure from higher costs. So on one flip of the coin, one side of the coin, we are seeing that rates are improving, but on the other side, similar to commentary from Werner and other ones on RFPs, it's not really outpacing their costs. So it's really flat at the moment if you're thinking about it. So we're stuck.
Yeah, let's pull up. Go ahead and go to my live screen view if we can back there. I've got the 2019 levels there in orange, and the white line is the current year. And of course, all the spaghetti noise is the years in between. You can see that on the left side, upper left side. But yeah, we're right in line with 2019. But this is magnificently horrible if you're looking at this from a demand side perspective.
Yeah.
If you think about demand side conditions in 2019, that was 6 years ago. Economically speaking, you should grow 3% every year minimum. And, I'm overgeneralizing to an extent. So if we've lost like 6 years of demand, that is not great. Now, the fact that we have 6% rejection rates at this point, and in 2019, the rejection rate was down under 4%. So that our capacity side conditions, which is a huge point here, you can't just look at demand side purely and get depressed and lost in this too much, because capacity actually suggests it's a tighter environment than it was in 2019 because we've had so much time for these carriers to kind of bleed out of the space. And we continue to see that in a lot of the data.
And that's one of the big things too. The capacity side, you can't sleep on the fact that truckload capacity, especially outbound tender rejection rates. Oh, look at this. There we go. Pull up that net carrier details of trucking authorities. Look at the bleed off. So we have ourselves, this is called the baseline view. Green is above zero. We have additions. Red is subtractions. This is calculated every week. So these are weekly changes in operating authorities. But you can see, look at the very far right as we're entering 2025. We saw capacity enter. We are coming up closer to equilibrium. But look, it's like Goldilocks. This is like the Goldilocks thing. We can't tell. And if anyone tells you that they do know the exact answer, please either have them call me or I need their stock picker, who's managing their portfolio. We don't know what the Goldilocks is right now, because right now it is just still too much capacity despite all of this demand destruction. And so that's one of the big questions as we're entering, the back half traditional trucking peak season. We really need to see how this goes, because it is a little bit in uncharted territory, at least over the past 5 or 6 years, because we're in a situation where we've seen such a degradation in red in operating authorities exiting the market. Now, somebody will tell me, they'll say, well, Thomas, this isn't really an exact one. This doesn't exactly answer my question. Yes, you're right. It's just like if you're going to go outside. I'm going to look at the temperature, the humidity, the precipitation chance. I'm going to look and see what tomorrow's. It's like the weather. So I'm giving you pieces when we're trying to figure out climate conditions for truckload capacity. But from looking at one of these things, we have to look at this from the angle. We don't have a group chat saying, hey, how many of y'all are still left in business? We do know that capacity exits continue. It's just right now, the big question is what will enough of that be, and what will it look like?
Yeah, we can go ahead and go back to the live view, because I got another view of this capacity side condition to look at. This is going to be the net revocations and the O-try. So O-try is in the orange, yellow color there. Net revocations is what traditionally, I mean, you and I probably looked at this chart back in the day working as an asset-based company, that net revocations was the way that you saw or gauged market health. The chart we just showed was the net changes, which is probably the right way to look at things because it takes additions and revocations into account. However, I will argue that revocations are still important to look at right now, because you look at that white chart there, we've had a huge bounce in net revocation. So this is just operating authorities that are leaving the space, whether they don't have active mileage on it for the last 12 months or they put in their notice that, hey, we're not active anymore. So the fact that we've had this bounce in net revocations over the last year, where conditions, if you look at the O-try, the higher the O-try goes, the more favorable the condition is for a carrier. And you can see the inverse relationship on the other chart. But there we go. We've had an increase in rejection rates over the last couple of years, arguably going on the bottom. But rejection rates increased and revocations increased.
Yep.
This is not an inverse relationship anymore. This is a nuance. We have a dynamic environment This is because we've had probably one of the longest one that I know of that we would consider a freight recession for 3 years now. So that means, they haven't had meaningful inflation on rates. So contract rates, spot rates are both depressed. They're not making a lot of money. If you looked at the actuary reports, would they go up 33% over the last 5 years?
Yeah.
The costs have, operating costs.
And that's skews towards larger fleets.
Yep.
That doesn't even count the other ones. And there's a great commentary by FreightWaves founder and CEO Craig Fuller, talked about how he had conversations with trucking executives as well. They had mentioned that which one is the worst? Well, this is starting to take the cake as the worst thing that fleet executives have seen in terms of environment in over 40 years. So this is becoming one of those kind of bellwether events similar to the great financial recession, which was for financial markets. It's very challenging. I think one of the stories here, because we're looking at the data, I like to add the anecdotes. And so conversations I've had and overheard while at this Volvo event, they sell to large fleets, they sell to customers, was that mimicked that chart that we looked at, which was you saw how total revocations started trending down towards the end of 24. Matched conversations I heard saying we were really hoping the market would flip. We were really hoping that the very part, after Christmas, it's going to kick off at least a sustained upswing.
Yeah.
New administration comes in, regardless of your politics, you shake the box of supply chains, the supply chain shakes back. Whether you agree or disagree with the fundamental reshaping of the global supply chains and financial orders, that's not my decision to make. But what I've heard was following this level of uncertainty, and that's the word, uncertainty in supply chains due to these tariffs, due to these changes, we saw that more carriers are leaving the market. Demand has fallen. We can see that in truckload demand. Yeah, pull the chart back up real quick in LTA 1 here. We got under guest 1. There we go. Look at that. So
yeah, this is your loaded container volume with the tender volume index here. And the thing that's circled is basically during the pandemic, truckload took share from intermodal because all the congestion at the railheads, the service levels were garbage, but shippers could not fill the orders fast enough to meet demand. So they threw it on the truck, which is the fastest way to get it across the country. The predominance of freight flow comes from China, Los Angeles, Chicago, into the megalopolis on the East Coast. And intermodal is cost effective. It's far more cost effective when you have time. And so what's happened now is that because demand has been suppressed, they don't have the same level of urgency around getting these goods across the country. Their inventories were glutted at the end of the pandemic. So you saw intermodal slowly kind of recover out of this trough, especially in 2023. And then all of a sudden in 2024, you saw intermodal volumes take off because we had a moment in the summer of last year in 2024 where we saw this huge spike of demand coming out of Los Angeles. And it's because we had this, the Red Sea confrontation caused all this uncertainty around shipping. Had nothing to do with the current administration at all. And so they put it on a truck and found, oh, wait, this is costing me too much money. So they figured out, hey, let's put it on intermodal. And that's what has really spurred a lot of the losses on the truckload demand side over the last year and a half, really. So you can see here, OTVI is down 35% since the peak of the pandemic, mind you. Don't get too caught up in that. That was 5 years ago that it's comparing it to. And intermodal is actually off about 2% from that, but you can see that they're moving in two different directions.
Yep.
And the fact that they're only off 2% from peak pandemic tells you something too.
The big story with that is that look how intermodal has rebounded. We saw stories about tens of thousands of extra cars. We've got the intermodal players like your Hub Group, JB Hunt, your Schneiders, everybody else is getting on it. One of the big things that the rails have done an excellent job of is fixing the service issues. And now that the supply chain is in a hurry up and wait approach, intermodal really has a great opportunity, unfortunately for truckload, to continue to hold. And so we are seeing that kind of situation where the modal shift is becoming much more apparent. It's just an additional headwind right now.
Yeah, and I think we haven't really seen, what we've seen over the last year. I look at those two indicators as kind of like a net in terms of goods demand in the United States. We've seen that earlier in the year. I pull up that chart. We're 10% up on intermodal, 10% down on OTVI.
Yep.
Right now, year over year, We're 2% down on intermodal, 15% down. There we go on OTVI. That's the year over year look, relative view. Intermodal's had some stickiness, but net demand has started to erode here in the last few months. And that's the thing that's the macroeconomic read on this data, is that we don't have the strong level of goods demand that we had at this point last year. Now, you can make the argument this time last year, the economy was a little overheated. I don't know how you make that argument too much, because I think we were actually in a fairly stable economic section outside of some pull forward activity.
Yeah.
Because of the Red Sea stuff, but we were fairly consistent with our goods demand. Inventory levels had stabilized for the most part. This year, inventory levels, we talked to Dr. Rogers, they're growing again. Like, we're starting to see people just go into this just in case-ish, not as strong as it was during the pandemic, mind you, but it's still kind of like this, I've got to make sure I have something here in case something goes off. That gives them more time to move goods across the country. Hence the reason intermodal is thriving in this environment compared to truckload.
Well, think about also, remember when we had the record amounts of TEUs coming into LA and Long Beach? Rail was able to handle it. That's one of the dogs that's not barking. July and August had some of the largest amounts of imports into LA and Long Beach on record. Now, depending upon who you ask, 70% of that inbound goes on rail. So what is extremely remarkable and kind of another dangerous thing for trucking is that when it counted, when we saw the craziness that in 2021 and 22 resulted in these service issues and congestion, the Class 1 railroad operators were able to handle that demand, and they're still hungry.
Yeah. Yeah. I mean, I've got a chart pulled up here for the Los Angeles IOTI. So this is going to be bookings for inbound imports coming into the United States through the ports of Los Angeles and Long Beach. And this is based off time of departure from their ports of lading. It's not hitting the port right away. So it's a leading indicator. That's what the IOTI is. It's a leading indicator for stuff that's about to come into the United States. By about 15 to 20 days for the ports of Los Angeles, Long Beach from China. And that's the majority of that freight. Now, you can see here, you see that big spike in July. That's that inventory. That's the recovery from the Chinese tariffs that were 145%.
Yep.
Early peak season. We're now diminished year over year from China. And some of that has moved into like Vietnam. India has actually lost a ton of demand here in the last few weeks because of the 50% tariff that Trump implemented there. But we're seeing a huge amount of this movement in where is freight getting sourced from. And there's a lot of speculation on forward-looking demand from the shipping community that they just do not feel comfortable with right now. I think most of them are leaning, as the last couple of charts have kind of showed you, the rail demand's down year over year, the import demand's down year over year. They're not feeling as strong about their demand situation as they were at this point last year.
I'll give you a great story about that. So let's dive into one. I was at the Volvo event. Volvo is part of Volvo Group. They have engines, they make trucks across the world. They even make engines for tanks. I'm trying to get that to happen. But let's give you an example of how just silly the situation with the tariffs is going on. So Volvo, like other large OEMs in the North American market, they make trucks in North America. Volvo makes their trucks in the United States. Most of their stuff comes from American-made factories with union jobs. The exact thing that, when we talk about the glory days of manufacturing, that's what you want. The cruel, bitter irony is other large OEMs in North America, most of those trucks that are assembled because of USMCA, UMSA, NAFTA 2.0, most of them are made in Mexico, and then they come up and get finished in the U.S. Now, there's a delicate balance and dance between Canada, U.S., and Mexico. We crisscross applesauce to try to get around tariffs and other stuff. And so the cruel irony is, because of the increases of tariffs, Volvo is actually getting screwed. Volvo's screwed more when, in fact, that they have the U.S. labor and the U.S. plants. These things are made in the Carolinas, for Christ's sakes. I was talking to Volvo executives, and they're like, you got to be kidding me. We're doing exactly what you want us to do. And then here we have folks like your other OEMs that I won't mention have cheaper Mexican labor, and most of the fabrications come from those places, and the finished truck is mostly finished, not even in the U.S. because of nearshoring and other things, which, some people can make an argument about the pros and cons and the morality. I'm not here for that. I'm just here for the money and tell you what I hear. Kind of like a bumblebee, I'm pollinating. But this illustrates one of the challenges, because these ripples are having an impact. I'm going to give you an example on a Class 8 truck. So when you want to make a big rig, folks, there's a lot of different parts. You got to make deals with things like the steering columns, the brake actuators, all these little tier one suppliers. So they come in. That can be something that's made domestically or it has to come in and get tariffed. The second part is the steel and aluminum, which currently has tariffs on them depending upon who you source. And then if you decide to go domestically, they're going to charge you more. There ain't no love lost.
Mhm.
If we decide to put 25% tariffs, the American manufacturers rightfully will try to charge you 20%. So that's another cost headwind. And then finally, we have a situation with the sourcing and the parts. Remember the Stellantis stuff?
Yep.
Remember they had to float 300 or
Mhm.
something $1 million to
Right.
their suppliers? Those are little ecosystems. This is like a pond, people. There are layers of
Yeah.
fish, but these are suppliers. This ecosystem is being completely disrupted. I talked to a guy who started in purchasing at Volvo.
Yeah.
You make a deal 3 to 5 years and you leverage your global brand to get a better deal.
Yep.
It has bit them in other large global OEMs in the butt because you know what you do? And he told me this makes sense. I'm going to combine and use, let's look at Volvo's Mack and the Volvo truck lines. The goal is you provide good quality parts, but you try to make as many of them as similar as possible. By the way, Daimler does the same thing with Western.
Interchangeable parts. It's,
yeah,
it's
interna-
something that's over 120 years old.
So I'll throw you some
Yeah,
math.
yeah.
Let's say that I'm going to throw out for hypothetical OEM, I make 10,000 trucks with brand A, 30,000 trucks with brand B in North America. Across the globe, I get another 100,000. So let's put on our thinking cap here. Thomas wants to save money, and he's going to have to make a deal with the supplier who's going to run a line. So what we do is we combine them all together, use the same parts, bada bing, Bob's your uncle, it works out until we add tariffs. Now, my great idea, because I'm sourcing from a global supplier, because now the world is basically not the United States, it's a conglomeration of countries all specializing in crap, that has screwed me. If you want to know just a microcosm of the uncertainty that's happening in the manufacturing sphere, because most of these are global companies, that is one example of you try to do a great job, you try to get a great deal, and now because of geopolitical realities, we're having a problem. So my final spicy take is that this is going to be structural. From conversations I've heard amongst large OEMs, the administration is aware of this situation. I'm also hearing that by sometime in the next months to hopefully in the next year, this will get resolved. But the uncomfortable truth right now is that we are going through what many folks, I was born in 91, so unfortunately the wall fell before I was born, but we are in a form of a global bifurcation. Unfortunately, the US and China, I call it Dragon Bear 2.0. There's a great lady on the X platform who's a geopolitical analyst about it. We are seeing spheres of influences now form what was once a global supply chain where, unfortunately for the US, other countries kind of got to take advantage. We got cheaper crap, so, it kind of worked for us too. But we are starting to see some of these broader changes, and I would expect in the next 5, 10, or 15 years, the U.S. will bring back manufacturing in a form. The North American continent will bring back some of this, but it's going to be a very rocky road, and I don't think that, especially from a macro standpoint, folks are not prepared for the fact that, the
Yeah,
very foundation of our global trade order, supply chains are now the front lines, is shifting. And so, some people smarter than me will tell you the same thing. I advise you to read them. But unfortunately, folks, my professional opinion is hold on to your butts, in the words of Samuel L. Jackson in Jurassic Park.
Well, I have a data point that kind of helps illustrate exactly what you're talking about. So this is the IOTI, the Import Tender Volume Index for, not tender, 20-foot equivalent unit volume index from India to the United States. This thing has collapsed. But if you look at the trend over the last year, this is the knee-jerking reaction. Like until just recently, everyone was thinking India was actually going to be a safe haven, Apple being probably the most famous. Since the pandemic, we clearly have had the China plus one thing, and now it's China or anyone else, maybe, we're not sure. The collapse of imports, and this is largely apparel, furniture, comes out of India into the United States. This is collapse. So if you were on this trend line thinking, hey, I'm going to do this because I'm hedging my supply chain exposure to China, because if you're overexposed to China, inflation was going to happen, tariffs, everybody's kind of expecting that. Nobody was really expecting India to be the brunt of this attack. Now, I think what's largely unknown is what you said in the, are we actually going to bring manufacturing back to the United States? I think, yes, some of it will be brought back here. But it is simply not, just like with Apple, it is simply not economical to do so for everyone. And we will not see the reshoring, flood. Also, this administration has 3.5 years left. It takes 3 to 5 years to shift supply chains around. Some of the stuff that you're talking about has been built up over decades. That is why these erratic implementations are so disruptive, because not only are you disrupting what they have spent years and decades building, infrastructure is very rigid.
Yep.
We don't move the railroads around the country for a reason. That is a very hard thing to build over time or quickly. A lot of these manufacturing plants don't prop up overnight. And supply chains, they're more efficient when you're building things closer to their sources.
And you're predictable.
Yeah. It's a predictable supply. You don't have to cross too many geopolitical boundaries and things like that. We were actually doing okay. Now, you can make the argument of national security, and we really kind of bled out a lot of the manufacturing. I'm not going to get into all that. And we did have some exposure, clearly, to international interests that we didn't want to have. But it doesn't mean that supply chains were suffering because of it necessarily. Yeah. From a pure supply chain perspective, we were actually moving towards a more efficient way of building, producing, and doing things naturally because we were in peace. We were getting along with everybody, right or wrong on that front. And I'm not going to argue that point, but for pure supply chain environment, and now the knee-jerking going on, and there's really no safe haven from a lot of these shippers' perspectives. Now, speaking of safe haven, I want to get into the news, the stories, because this has been a huge topic as people have moved around and had all these sourcing issues. The maritime space, fairly quiet from a rate perspective. However, Maersk came out with an announcement. We're supposed to get this surcharge on Chinese-built vessels. Yep. United States going into effect here in the next month. Maersk has come out and said, and I haven't heard of any of them say that they are actually going to bill in this surcharge for if you are delivering on a Chinese-built vessel, because the United States isn't going to charge you for having that vessel. They're saying they're not going to pass that along. Now, this clearly, along with all the other things, such as tariffs and changing of procurement, sourcing strategies, is just one more thing on the shipper's agenda that they have to deal with. That's an inflationary cost. Now, Maersk probably doesn't want to get, and this is coming from our CEO and founder, Craig Fuller. Yep. His theory is that these big vessels and shipping, these shipping lines don't want to get targeted by the administration.
Cold War 2.0.
Yeah.
The front lines now.
Yeah. So if they draw attention to themselves as saying, look, we're going to pass these along and it's going to hurt the American consumer, that hurts obviously the rhetoric around, hey, this is for America. So they're trying to stay out of this, at least publicly. Now, we'll see. Time will tell on how this actually manifests, because a lot of these fees are hidden. As somebody who has priced freight for a long time, if you don't want an accessorial, what am I going to do? If that still is incurring an extra cost to me, guess what I'm going to do?
That's how you make your money, too.
I'm going to hide it. I'm going to put it into the base cost of the thing. And of course, the maritime space has the ability to do this with far more effectiveness than the domestic transportation in the United States. So I want to pull up the FBXD. Which is going to be, I'll pull it up. Yeah, there we go. The FBXD. Now, this is the spot rate from China to North America's east and west coast, and the difference between the two, the Panama spread there, as we effectively call it. You see those rates jumping up here. Now, it's in front of Golden Week, which we're about to get. This is a seasonal expectation of increase, but you see we're still actually higher than we were. And a lot of times, they have pricing power amidst a demand side decline.
Because they laid down to a lot of those ships. Yep. They had to also shift capacity amongst the cartels, the maritime cartels. Here's something wild. I just want to get a quick thought. I want your take on this. So when we compare about the tariff environment and everything happening, the 30s was the last point of reference, right? But the problem is, back in the 30s, the U.S. was like China. We were the ones who were dumping Philadelphia steel or Pittsburgh steel into the market. And so how do you now in 2025, not only do you have to bully other countries to pick a side, you got to bully the maritime cartel. So these
Mhm.
moves by Maersk, whether you want to pass on surcharges or not, we have so many added dimensions now because there's so many more players at the table that, this is why I really like getting on the show with you. You got to pay attention to the supply chain
Yeah.
because now you're literally, if you're Maersk, what are they? Are they Dutch? Where are they from again? I'm a truck.
Yeah, they're Netherlands.
They're Netherlands. You think some Dutch guy wants to get caught up saying he's helping the Chinese because a bunch of their flagged vessels are Chinese, and then next thing you know, the administration's like, I'm going to target you. And so it's such a crazy dynamic, and that I don't know the answer to, but I love the fact that it's something you got to think about now.
Well,
It's another wrinkle.
these manufacturing supply chains, for something like building boats, enormous.
We got to go to the Koreans now. We can't build our own boats. We
Yeah.
have to hook up with. There was a recent thing with Japan and South Korea about naval
Yeah.
shipyards and refitting and stuff. Like, it's insanity to think that how crazy if you had a Hollywood screenwriter and we're writing one of those stories like Tom Clancy. I wish Tom Clancy were alive today because how the heck will you have to figure out that in order to fix American shipbuilding woes because we're wholly behind,
Yeah.
we're going to partner with the South Koreans who are going to take over some of our poorly performing ones, and they're just going to build some ships for us. So it's this crazy thing where now we have to zoom out. It's like a 4K video game now when it used to be just a two-dimensional Tetris,
Well, there's a reason that you build boats where it's cheaper to build boats, and that's why they're built where they're built, because it's the most cost-effective and efficient way to manufacture these vessels in the current economic environment. Now, it doesn't mean that we can't change, but it's like the difference between the cost of living in California and the cost of living in Nebraska.
Yep.
You don't build a bunch of stuff in California because you have to pay more for that labor than you do in Nebraska. It's no different in the global supply chain environment, and that's why things are built in China, because the labor costs are way cheaper. Right or wrong, again, not saying that that's the way it should be or optimally should be. We should build some stuff here for sure. We probably have gotten a little loose with some of this stuff, but ideally, supply chains operate at their best when you can build and source close together and then move that stuff to where the end users are. And we're getting away from that with this global fragmentation that we're dealing with. Now, the next story I want to get to here, tariffs torching U.S. container imports. This one here, written by Stuart Charles, does a great job here. Now, he's interviewing an analyst for this. Our IOTI, I think, helps illustrate this quite effectively that I talked about earlier. Now, I wouldn't say that we're seeing a torching of U.S. container volumes, but we're certainly seeing a pretty decent sized degradation
Yep.
in overall demand. And torching is a little hyperbolic for me in terms of what we're actually dealing with. I think if you're looking at it from a year over year perspective, probably, especially when I showed you the chart of Los Angeles and Long Beach, India, for sure, that is a torching of container volumes. But overall, we are seeing some movement. Vietnam, for instance, Thailand, both increasing in year-over-year volumes, container volumes, coming into the United States, which is reflected in the IOTI. So there are some other things at play here that are going on where this manufacturing is getting shifted into other places. And it's not a pure like, hey, that's just gone now type situation. So something to watch. And I think it's interesting too that rates, we just talked about how volumes are going down after we talked about rates going up a little bit. This is definitely going to be a mechanism to watch because we're talking about the exact same stuff in the truckload environment. And I want to get to the next story here that I want to get to is on truckload earnings estimates being cut in Q3. So clearly we're in some sort of economic like holding pattern. It's not looking great right now, at least in terms of expectations. A lot of the bigger carriers, including Knight-Swift, which has kind of been the poster child of operating efficiency here in recent years, all cut earnings. Third quarter earnings per share estimates were cut by 12% and 11% for Schneider National and Werner Enterprises, respectively. Numbers were trimmed by just 6% for J.B. Hunt and 5% for Knight-Swift. So all of the big ones are saying, look, still not a great third quarter. We thought we were going to have a better one. And I think this is just endemic of the situation of we're still kind of stuck in this market. And a lot of that maritime stuff that we're talking about kind of compounds this, because if we're not seeing volumes in the third quarter after the big import boom, the early pull forward type freight. But Dr. Zach Rogers had a good point that we had a few weeks ago. A lot of this freight went into a warehouse.
It's hiding
It's
somewhere.
hiding. It's hiding in the supply chain. So don't get lost in the traditional imports come in, imports move out.
Yeah,
type
big boom
mentality.
following.
There have been expanding lead times, and this demand surge, I think, has potential. And not in the sense that I think we're going to see this huge, booming fourth quarter holiday peak season from a demand side perspective purely. I do think that we have the potential to see some pretty decent disruptions in supply chains because we're just not as well prepared from a supply side dynamic. And the chart that I want to show you here, because we already saw this, this has already happened. I want to show you the contract versus spot chart here. Last year, the spot market blew up around the fourth quarter. And we've been, if we pull up this chart of contract versus spot, contract rates have flattened. They're not responsive
Yeah.
at all. And I've got some interesting back end data that I just saw this morning from our data team. Kudos to them. That actually tells me that we're now in a complete stagnation in terms of rate increases versus decreases. There are far more. There's about the same number of rate increases than there are decreases going on with contracts right now, based on our data. That VCRPM white line you're looking at,
Yep.
It's been flat for a year. Well, some of that was offset by volume, in terms of the volume was going into some of the higher value contracts and lower value contracts. Now we've got almost a complete deadlock in terms of, and this could be a 1% up, 1% down, 5% up, 5% down. We don't know. We didn't measure that, but we're now seeing pretty much a holding pattern on all contracts, and the spot market is increasing underneath it.
Which is positive because spot market is kind of like, in the Iditarod race when you have all the dogs on the dog sled. The spot market is the lead dog. It's it's one dog. I don't know what the amount for Iditarod team is if I have like 10 dogs,
Yeah.
but it leads the rest of them. So the good news is at least there is a little ray of hope. Look at that bottom, see the little line going up. We're starting to see it, but it's not enough. And we'll probably hear on earnings calls where they will say we could not convince customers that we are able to get substantial increases other than just enough to cover our cost, because we have to tell them, I may be poor if you don't help your brother out.
Yeah, contracts, of course, at 15% less volume mean that year over year, if you do the math, that's 15% lower at the exact same rate.
And their length of hauls, if you look at it, and I'm going to make a prediction here. We're going to it's really easy low hanging fruit. Average tractor count is probably going to go down. Revenue in terms of revenue miles per tractor is probably going to go down. In terms of revenue miles. Now, revenue will probably be up into the single digits. I'm pretty confident because what we continue to see for fleets doing this is called, Thomas calls it the old circle the wagons and pray, which first involves convince your mix to go to dedicated. If you're 50-50 with OTR and dedicated, you're already dead. You just don't know it. You want to get up to 65 or 70%. We continue to see that happen. Pay attention to the one-way sector in Werner. Pay attention to Knight Swift and US Express in terms of their OTR segment. We should continue to see a situation where that segment is going downwards. I spoke with a large automotive customer. They have hundreds of trucks. They're doing the same thing. Migrate to dedicated, migrate into these kind of routes that are at least predictable, sustainable 3 to 5 years. And the other thing that we're going to have to pay attention to right now is we're going to continue to see that. So you're going to see that the numbers may look a little better. Pay attention to average tractor age, average trailer age, and total tractor count. Those are canaries in the coal mine. You have to pull them back to goose the numbers. And we'll probably continue to see that despite the fact that driver availability remains positive.
Yeah, and the last chart I'm going to show you here is the length of haul chart based on, if we go to the live view of my screen here, that white line that's showing growth year over year, that's loads moving less than 100 miles. Those lines down there at the very bottom, it tiers almost perfectly down in terms of length of haul, long haul freight demand. So anything moving over 800 miles is down at the bottom year over year by the most part. And that is another reason why we're seeing such challenging conditions for the transportation service providers. And this is why they're not sustaining. This is why carriers are still coming offline. And this is why there is an inherent risk in the fourth quarter, because seasonally speaking, more carriers come offline in December, January than any other time of year.
No pressure.
So if you make it through this one, you've got something. And I think that, this will turn,
This too shall pass.
Yeah.
We just don't know when.
we don't know when, but it's coming. And you still have to be mindful that even if the economy is suppressed, there's still a risk.